the practical import of the need for more power and less particulate pollution means you'll see more nuclear. But if you understand the anatomy of prior bull markets, you'll understand how to play this one better. All by itself, I don't need to maximize leverage. I don't need to maximize alpha when I'm expecting 600% beta. I would rather underperform a bull market very, very, very safely than outperform it, taking extraordinary risk. I love asset classes that people hate, and people hate silver equities. I think the silver price goes higher. Maybe it takes 2 years. And I know from past experience that the combined market cap of the legitimate silver companies is so small that when the general investors come into it, the market cap won't be able to hold the money, which is to say that the prices will likely explode higher.
Hola a todos, bienvenidos. Hoy tenemos el honor de hablar con Rick Rule, inversor y especulador de gran éxito, con 50 años de experiencia a sus espaldas como financiero en recursos naturales. Director de Sprott y CEO de Rule Investment Media, Rick Rule ha estructurado, dirigido y participado en cientos de emisiones de deuda y capital privado para empresas de recursos que operan a nivel internacional y ha trabajado en numerosos países. Rick Rule también ha presentado cientos de conferencias de recursos e inversión durante los últimos 30 años y hoy nos ha concedido el placer de entrevistarlo y atraer este mundo al público hispano. Además, vamos a dejar abajo en la descripción la página web de ruleinvestmentmedia.com, donde podéis mandarle vuestra cartera de recursos naturales a Rick y de vuelta os responderá con una puntuación del 1 al 10, dando un ranking a vuestras acciones de materias primas. Esperamos que os guste. So Rick, how are you today? Thank you for coming and happy Christmas, by the way.
And to you, best of the season to you and yours. In answer to the question, I'm doing very well. I'm speaking to you from Vancouver, British Columbia, cold and wet, but I'm doing fine. Spirits are high. Looking forward to talking to your audience. Thank you.
Thank you. So, Rick, the first question, we are going to introduce first the macro and inflation, as Luis told you. Then we're going to talk about metals and energy. So the first question I would like to ask you is, how do you see major global macro trends in the near future? Like, how is it going to affect your investment decisions, everything that is happening right now?
I think it's best to say that there are counter trends. So that all I'm certain of is volatility. On the one hand, underlying economic demand seems good. That is, from my own point of view, probably more as a consequence of government stimulus and artificially low interest rates, both in the European community and in North America, than it is quantum improvements in productivity or anything like that. So in the very near term, I think that equity markets will probably do well, simply because there is so much equity on the sidelines. A little bit longer term, and I become much more concerned. Markets that exist because of liquidity rather than other kinds of fundamentals are, in my experience, fragile markets. I would caution your audience that I'm not an economist, I'm a lender, and my comments take into account the fact that, while I don't study economics, I try very hard to get paid back. The consequence of that is that I pay attention to history. My biggest concerns are twofold. One, the middle-term consequences of government policy, quantitative easing, which if you did it would be called counterfeiting. Debt and deficits, I don't know the European numbers, but in the United States, on-balance sheet liabilities at the federal level exceed $29 trillion. And off-balance sheet liabilities, pensions, health, stuff like that, exceeds $120 trillion. And we propose to service this with a budget that's in deficit $3 trillion a year, which is to say it won't be serviced. The third concern is negative real interest rates. Think for a second just how silly this is. You save, you forestall consumption, and you pay me to spend for you and take the credit risk that you're going to get paid back. This is completely illogical. Any circumstance that subsidizes spenders on behalf of savers is one that is necessarily challenged. So that is one of my concerns. The second of my concern is a bit more philosophical, I suspect, which is to say, there is an increasing disconnect in developed nations between the skill sets that the citizenry has on offer and the skill sets that the economy demands, which is to say that you have millions of jobs with no one to fill them and millions of people who can't get jobs. The consequence of large portions of the citizenry that don't have enough education to offer up utility to the economy means that the gap between rich people and poor people continues to grow. And both sides, the rich people and the poor people, will look to the government to fill that gap. I don't believe that history has shown that government is an instrument of good, but rather is an instrument of power. So the idea that the economy is turning to the government to solve social problems, I think is extremely dangerous. And in that context, I'm a little nervous about the economy in the middle stretches. I would be much more concerned, Javier, were I your age, because what debt really is, government debt at least, is the product of old people like me voting themselves all kinds of benefits and services and leaving you the bill. That's what debt is. It's an income transfer and a wealth transfer from harder working, younger, less affluent people to older, more affluent people. And while I'm a beneficiary of it, I guess, from your point of view, I would think it a horrific development.
So you said, for example, for the near term, you talk about liquidity, but liquidity, it's driving markets right now. But do you think liquidity, like maybe solvency, could be a problem?
I do. Yes. And I love your choice of words. I actually have a speech that I give about that, about the difference between liquidity and solvency.
Okay.
And I think you put your finger right exactly on the problem. People worldwide are confusing liquidity with solvency. If if you've borrowed $1 million, or let's make it, if you've borrowed €1 million and you have 60,000 euros in income, you're insolvent. But if you have 10,000 euros in your pocket, you feel liquid. There's a big difference between liquidity and solvency. And I think the market and many participants are confusing the two.
So, and what about inflation? So we talk about debt, but how do you see inflation going forward? Because I think, in the last meeting of the Federal Reserve, like they changed the estimates for, I think, 40 basis points for 2022. But how do you see the inflation going forward? Like, are they going to make it transitory, or do you think this is like is going to continue forward?
Well, first of all, the Fed's track record in terms of forecasting inflation or other things is virtually unblemished by success. The idea that people look at their numbers, I think, comes from the fact that people are too lazy to do any work themselves, and they want to allocate responsibility and blame to somebody else so they don't have to do it, irrespective of how faulty the numbers are. So let's dispose of that first. The Fed numbers are fiction. When people say that they're afraid of inflation in the future, I need to say to them, you don't need to look into the future. Inflation is with us right now as we speak. The people in my country that compile the inflation numbers don't shop where you and I shop. That's the only thing I can think to say. They, when it's inconvenient in terms of calculating core inflation, don't include food and fuel. As you can tell by looking at me, I eat. And of course, I drive. More importantly, in both Europe and the United States, when the big thinkers calculate cost of living indexes, they don't include tax. They don't include government. The idea that my cost of living didn't include government is preposterous. If I decided not to fund government, they'd throw me in jail, which is not my way to live. So let's look at the arithmetic of inflation right now. were you a saver in the United States. You buy a US 10-year treasury, US dollar denominated, the most liquid savings instrument on the planet, and the US government pays you 1.5% a year in a currency that they acknowledge is being depreciated by 6.5% a year.
So no material value.
They absolutely guarantee that you'll lose 5% of your purchasing power compounded over time. My friend Jim Grant famously calls that return-free risk. The essence of inflation is being able to, or being willing to stand return-free risk. Why would you do that? It's difficult for me to understand. Well, it isn't difficult for me to understand. We've lived through 40 years of benign economic condition, and people are conditioned to believe that the big thinkers of the world, the Fed, have their back with a put. People are conditioned to believe that interest rates will continue to decline, and hence bond prices and equity prices will go forward. I would suggest to you that at least in the US, where the interest rate on the 10-year treasury, pardon me, has fallen from 15 plus to 1 plus, that the era of progressively lower interest rates is over. And we're going to have to begin to get used to an era of higher interest rates, which will be somewhat less benign. Catastrophic? No. But do people need to be concerned about the time value of money and the maintenance of their purchasing power through investing and saving? Absolutely. And the government will not be your friend in this.
Yeah. Actually, following the discussion about the inflation and interest rates, I watched the other day an interview with Paul Tudor Jones in the CNBC that reminds me a lot of what you have been saying in the past. The headline actually says, "Go all in on inflation trade if the Fed keeps ignoring higher prices," which is what we are talking about here. And the three main topics that I want you to elaborate on that, because I know that you have been very vocal about these three topics, which are the reverse to the mean in the commodity spectrum of the $80 trillion that the hedge fund managers manage, and with the inflation compared to 2011, for example, the short squeeze. There is a really short squeeze in the commodity complex. Well, not short squeeze, a short position in the commodity complex, not yet a short squeeze. And also the three-way question, the Reddit crowd investing, taking the narrative to invest in this sector. So it's actually a three-way question that you can elaborate on that.
Well, I would begin by saying that it's imprudent to go all in on anything. There is a temptation when the narrative is very strong to believe that the narrative has to come true. And if it has to come true, that it has to come true quickly. We did a word play earlier, and I would remind your listeners, particularly your young listeners, of the difference in meaning between two words in English. One is inevitable, which means it has to happen, and the other is imminent, which means it has to happen quickly. And if you go all in, you often don't have the staying power to stay the trade. Reversion to mean, however, is something that all investors need to pay attention to. And I think that you need to do reversion to mean in two different circumstances. First of all, interest rates ultimately, I think, will return to mean, irrespective of the big thinkers. And that's a sort of a scary proposition. I don't know the European numbers, but in the United States, the US 10-year Treasury traditionally has sold at a positive real yield to the depreciation of the currency. If the depreciation of the currency is 6.5%, that means if you reverted to mean, that the yield on the instrument would be 7. If you can imagine the impact on federal, state, and local budgets on the prime interest rate and on the 30-year fixed mortgage rate, if the yield on the US 10-year Treasury went from 1.5 to 7, that would have interesting consequences. I'm not saying it's going to happen immediately, but I do believe in reversion to mean, and reversion to mean means interest rates go up. The other side of the inflation trade, of course, is precious metals. And I believe they'll revert to mean too. There are, and I apologize for using so many US as opposed to European numbers. I do so because I don't know the European numbers and I don't want to deliberately mislead your audience. But the market share of precious metals and precious metals related assets in the United States relative to other types of savings and investment products is 0.5%, which is to say 0.5% of the value of savings and investment assets in the United States is in precious metals or precious metals related securities. The 3-decade mean is between 1.5% and 2%. So if you had reversion to mean as a consequence of inflation concerns, demand for precious metals and precious metals related assets in the largest savings and investment market in the world would triple or quadruple. And that's what I think is going to happen. Will it happen in 2022? Probably not. Will it get started in 2022? Probably. But I think reversion to mean is as important an investment concept as any other out there, particularly now, where my belief is that investors are paying attention to 40 years of history with recency bias, without paying any attention to the consequences of the forces at play today.
And do you think that what the commodity complex has, if you know the numbers, or do you know a little bit about how if there is a real short position in the commodity complex? I only know about the silver numbers, because what they say that there is 180 per paper, physical paper, silver paper, oh my God, paper silver for each ounce of real physical silver. So there is a lot of short position in this complex that can get a move in the commodity price. But that is just an speculation. What I'm really about, and I think you are as well, is fundamentals, a lot of value oriented. And in 2019, in the PDAC conference, you said something very interesting, that was the supply destruction in the precious metal complex, as well as other commodities. That for fundamentals, I mean deficit in the supply demand fundamentals, not enough ground inventory, and the all-in sustaining cost above the price of the commodity. What Rick Rule sees, in which sector of the commodity complex does Rick Rule think that there's going to be a price appreciation in the next 1 to 3 years? As I recall, not imminent, but it has to happen.
You have to give me 5 years, not 1 to 3.
Okay.
And if you do that, and you assume that there isn't a global recession or depression, which whacks demand, everything goes higher. Everything goes higher. Supply destruction is really a consequence of 2 related factors. The first is that financially, the world has underinvested in productive capacity around commodities for 30 years. Copper, potash, oil and gas, coal, all those things. In the copper business and the oil business in particular, the world is living on deposits and technologies that are, well, they're as old as I am. Let's just say they're past their prime. Look at the big copper mines. Chuquicamata, 110 years old. Teniente, 100 years old. Bingham Canyon, 150 years old. Grasberg, 40 years old. You don't stand in a mine mouth, throw in water and fertilizer and grow more copper. That's not the way it works. You have to go find a copper mine, permit a copper mine, build a copper mine. That takes decades and billions of dollars. Irrespective of what we do in the next 5 years, other than having an ugly recession or depression, we will see supply shortages. There is a policy mismatch between the way the big thinkers would like us to live and the way that we want to live too. And the consequence of that is that there are policy disincentives to produce hydrocarbons, to produce coal, to produce oil and gas, as an example. The big thinkers would like to disassociate from hydrocarbons in the near term, but consumers have a different point of view. When the consumer goes to his or her car and turns the key to the right, they want the car to start. When they flip the switch on the wall, they want the lights to come on, and that requires hydrocarbons. It's estimated that globally, the oil and gas business is deferring $1 billion a day in sustaining capital investments and in new project investments, which means that the world's productive capacity of oil and gas is declining at the same time that consumption of oil and gas worldwide in developed nations is increasing. The other thing, Luis, that I think we have to consider both from a moral and an economic point of view is that we've done a superb job as a species in the last 30 years in raising the material living standards of the poorest of the poor on Earth. The 3 billion poorest people on the planet have come a remarkable way in the last 30 years. They would like to live like you and I live. And in order to increase their material standard of living, we have to produce more material. 1.2 billion people on Earth have no access to electricity. Over the next 10 or 15 years, they're gonna get it, and they should get it. 2 billion people on Earth have access to intermittent or for them unaffordable electricity. They need to get it too. This increases demand for energy, but it also increases demand for things like copper that facilitate the utilization of that energy. And in transportation, you go to a very poor market, say Malawi or Nepal or Bolivia, there's a transition taking place from barefoot to shoes, from shoes to bicycles, from bicycles to 50cc motorcycles, from 50cc motorcycles to Toyota Hilux vehicles. Regardless of what Mr. Biden or Mrs. Merkel thinks, the people who have progressed from barefoot to Toyota Hilux think that they are better off. And the consequence of that is that there is more demand for materials that power that truck and for the materials that are necessary to build it. What the World Economic Forum thinks, you know, all these people who go to Davos once a year in their private jets, what they think is appropriate for poor people and what poor people think is appropriate for poor people are very, very, very different topics. And the consequence of that is very bullish for commodities because there is a regulatory climate of underinvestment in commodities, which means that existing productive reserves and resources should be worth substantially more over the next 5 years.
Rick, before you talk about silver, the demand increasing, we talk about the supply chain destruction, we talk about energy, commodity consumption. I can also translate this into food, I think. I think also the demand for food is going to increase a lot, and that takes also consumption of commodities. But, and also I think assets, because if you get richer, you want to buy a house, you want to invest in the stock market, you want to see Rick Rule's video to buy some commodities. And what do you think this is? Do you think there's going to be an asset shortage, physical or financial asset shortage? Or do you believe there's enough resources for everyone? Should we innovate? What's the solution here?
Well, I absolutely believe that there are enough resources for everyone if the market is left to sort itself out.
Okay.
That doesn't mean that there won't be temporary dislocations that are extremely, extremely unpleasant. You mentioned that younger people want to buy houses. Older people who already have houses don't want increased density. Younger people who want houses need increased density because density yields affordability. So I'm certain, I don't know this, but I'm certain that you're having a clash in Lisbon right now between older people who have housing and don't want increased density and younger people who want housing. There's a joke in North America that until you have built your house, you're a developer, and after you've built your house, you're an environmentalist, which is to say that there are NIMBY-style constraints around that type of development. Certainly, innovation will yield many more practical, many more economic ways to utilize resources. Many people, when they hear me make fun of the big thinkers, think I'm opposed, as an example, to wind and solar power. I'm hugely in favor of wind and solar power. I'm hugely in favor of nuclear power. I'm hugely in favor of pumped storage. I'm hugely in favor of all types of technical innovation around power generation. I just understand, which the big thinkers don't seem to, that solar power works better in Spain, where the sun shines, than it does in Germany, where the sun doesn't shine. I understand that in Europe or North America, if we were able and willing to spend $6 or $8 trillion on the grid, on a smart grid, that we could utilize intermittent supplies of energy and fixed supplies of energy much more efficiently than we do today. If we were to spend that $6 or $8 trillion on the grid, it is likely that the redundant energy that we would need in either market would fall substantially, which means that the same generating capacity could service 30 or 40% more people and better. But we haven't done it yet. There seems to be a question as to who might benefit. I mean, heaven forbid that the people who put up the $6 or $8 trillion to improve the grid make an economic rate of return. If you are an elected official and you are taking money, diverting money from politically expedient domestic spending programs and using it to refurbish a grid where the benefit will be available 10 years from now or 15 years from now, when you will be out of office, you have no incentive to do that. So in addition to technical innovation, the world needs social innovation. Mercifully, there is a wonderful tool of social innovation that has been accessible to humankind for 5,000 years. It's called a free market.
True. That's true.
Okay, so in this energy transition, how do you see the EV metals? Like, do you see they're going to play an important role, like the demand for nickel, cobalt, lithium, copper? Are you bullish for the long run?
I am, but I want you to recast the question in terms of electric metals. In the West, we think of EVs, we think of Teslas. Around the world,
yeah. Meaning in energy metals.
Yeah, if you ask the question in terms of energy metals, I think the answer is yes.
Okay.
I sell the thesis to young people in rich countries by talking about electric vehicles, but the truth is that the answer involves the continued electrification of humankind. The increasing demand that you will see in your lifetime from frontier and emerging markets will dwarf the demand that you will see from electric vehicles, although electric vehicles will be the icing on the cake. Having scolded you now, I think that the demand for specialty materials and materials that contribute to the electric economy, and particularly to distributed storage, which is a fancy way of saying batteries, are a wonderful, wonderful, wonderful investment theme. And I think it's an investment theme that, although it will be volatile, will be with us for 10 or 15 years, which is an excellent set of circumstances. I'm particularly interested in it because although we've all seen it coming for 15 or 20 years, society hasn't invested substantially in nickel production, in cobalt production, in copper production, in the productive capacity around these materials. So although we've seen it coming, just like we've seen the need for a distributed smart grid coming, we haven't done anything about it, which means that it would seem to be a trend that absolutely has to happen as opposed to one that might happen.
The supply, yeah, everything has to do with the supply issues. There is the head of the commodity, Jeff Curry on Goldman Sachs. He calls it the revenge of the old economy, and I agree with that. For the last several years, there was not money. The money was in cryptocurrencies, was in other hot topics, but not in putting the supply needed for all these natural resources. And as you said, you are bullish oil and gas. You think they are going to be still here for decades, and you've always been really vocal about uranium. I was 3 weeks ago. I was in the ADIPEC conference, the big ADIPEC conference in Abu Dhabi, and there was a meetings of every Minister of Energy. They only talk green hydrogen, solar, and wind. That was the three hot topics, and no one in the main stage talk about nuclear energy and uranium. So I had to ask. I always was raising my hand, saying, "And what about nuclear power? What about uranium?" Do you think that in the future this is going to be a hot trend?
Of course I do. people are concerned globally about carbon and other forms of particulate pollution. The most efficient form of baseload power generation in the world that doesn't generate particulate pollution and carbon is nuclear. I understand that noted physicist Greta Thunberg doesn't think that the world needs nuclear, but in that circumstance, she's wrong. And I think that the technical debate is over. The political debate is still ongoing, of course, but we are seeing countries around the world, including notably the Emirates, that when you get away from their public pronouncement, have understood that if they build nuclear power plants, that they can ship and sell the natural gas that they're currently burning to generate power for much more than the utility that they receive for that power. In other words, if they can substitute nuclear power for natural gas-fired power, they pay out those plants in a whale of a hurry. So I think irrespective of what the World Economic Forum and the big thinkers in government think, voters and ratepayers around the world, when they walk into a room and want the lights to go on, if they want it to go on without increased levels of particulate pollution, they'll become pro-nuclear. Look at the experience that Germany has had de-emphasizing their nuclear fleet. Power costs, I mean, through most of Europe, but led by Germany, to the consumer are now up 500%, even while power has become more intermittent. And Germany has made up the gap in nuclear by burning more coal, including very, very, very low quality, high sulfur, high ash coal. They've had to do it to keep their population warm. At the same time, they've had to import more power, ironically, much of it from France, nuclear power. So I think irrespective of what the pandering big thinkers want or believe, that the practical import of the need for more power and less particulate pollution means you'll see more nuclear. In the People's Republic of China, the government has said that airborne particulate pollution from burning oil and burning coal and from transportation fuel kills 500,000 Chinese people a year. They see it as a public health challenge, and they have said publicly that the way around that public health challenge is more nuclear power.
Yeah, you've always said that a big trend was going to be the Japanese restart of the nuclear fleet, but China, they announced, I think, I don't recall the number, but they want to build 150 reactors. This is going to be a really huge demand going forward in a market that is really tight in that deficit with low inventories. So let's see what happens.
China will be the story 10 years from now and 15 years from now.
Yep.
Japan will be the story next year and the year after. The Chinese need to build plants. The Japanese merely need to flip the switch on plants that already exist.
Yeah, that's great.
Okay, so now going to metals, talking about metals. Before we talk about the purchasing power, we talk about debt and deficits, we talk about inflation. So if metals are like the backing everything, like we want metals when purchasing power is reduced, we want metals when inflation is a big problem and we are concerned. So why do you think metals are not rising right now? Maybe we are still in a bull market, but we are just correcting a little bit during this whole year, or do you think there's another reason? Maybe the expectation of inflation here 5 years forward, it's very low, or why do you think maybe cryptos? I don't know. We don't compare cryptos with metals. We don't think they are comparable. But what do you think about all of this?
A big question. The reason I think that metals prices haven't reflected economic conditions is recency bias. People's expectation of the future is set by their experience in the immediate past. People aren't paying attention, either because, like you, they weren't alive in the 1970s, or because if they're my age, they don't remember the 1970s. And the period of time that we have had since the 1970s, from 1982 to present, has been a time when inflation expectations were low and interest rates could fall. It has been a time that has been benefited by more economic efficiency, productivity increases, and globalization, world trade. That period of time, at least in terms of efficiency, isn't over, but we are in a circumstance where the economic circumstance is different. We've decided to fashion our growth, if any, from monetary policy as opposed to from economic recovery. So there isn't an expectation of inflation, and there isn't a knowledge any longer of the perniciousness of inflation in the public consciousness. Two, one of the responses to inflation, and it's worked for 40 years, is that the best companies in the world, the biggest companies in the world, where there are barriers to entry in their business, can raise their prices. And so there's a sense in the United States, at least, that the S&P 500 is a substitute for gold, that owning a diversified portfolio of the biggest and strongest companies in the world gives you access to increases in pricing power that can offset inflation. And by the way, I believe that's partly true. What hasn't hit the market yet is the perniciousness of negative interest rates on bonds and savings products. The institutional investor worldwide has existed in a 60-40 world, which is to say that their investment allocations in a broad sense were 60% equities for growth and 40% bonds for stability and countercyclical performance in volatile markets. The biggest institutional investors in the world, the pension funds, the university endowments, can't afford that anymore. Having 40% of $1 trillion endowment in an asset class that's losing you 5% of your purchasing power every year, when you have obligations to beneficiaries 20 or 30 years from now, means that we are going to head into a period for 10 years of extraordinary disintermediation from debt instruments. Or we're going to have a free market in interest rates, take the interest rates up, and takes all sectors of the economy down. Those are our two choices. My suspicion is that we will have the disintermediation from debt instruments that I described because neither the voters nor the government want to have a free market interest rate. And I think that that will be very good for precious metals. Will it happen next year? I don't know. The year after? I don't know. But I think it's much more likely than not to occur. And I think that investors who don't reflect that in some measure of their portfolios will make a mistake. The second point that you made, sorry for that long-winded answer, but it was a complex question. The second thing that I think that you need to understand is that even when an asset class has to go up, it doesn't have to go up immediately, and it doesn't have to go up steadily. Sure. If you examine the anatomy of the two prior precious metals bull markets in my lifetime, the 1970 to 1981 bull market and the 2000 to 2011 bull market, what you will see is very strong and prolonged cyclical declines in secular bull markets. These secular declines, in terms of duration, can be as much as 18 months. Okay. And in terms of dimension, in 1975, there was a cyclical decline in a secular bull market that was a 50% decline. So people who don't have the financial or psychological wherewithal to stay a trade that's that volatile are going to miss the bull market. I would encourage all of your listeners to access a chart, which I will happily send them, which is the Barron's Gold Mining Index, which is the broadest and longest running gold equities index that I'm aware of. I'm not advocating it because of any adherence I might have to technical analysis, but rather if you look at that index and you see, first of all, the average duration of bull markets, They're decade-long affairs, not 2 or 3 year long affairs. The dimension, which is to say the gold price doesn't increase by 50 or 60%, but rather over the bull market by 500% or 700%. And the equities, by the way, do better. And the volatility. If you understand the anatomy of a bull market, not that past is always prologue, but if you understand the anatomy of prior bull markets, you'll understand how to play this one better.
Okay. Thank you, Rick.
I actually totally agree with all you have said. So for people watching at home that think that, okay, maybe these guys are right, how can they participate in this bull market? Okay, I want to buy mining companies. So how do I start? How does Rick Rule value mining companies? For example, you said the if yes or no questions that you ask, the EV per ounce metric, if you think it's important, MPV, price to cash flow. How does Rick Rule value mining companies to put it in his portfolio and for the audience?
My most important criterion. Let's back up a little bit. Constructing a gold portfolio, I think you start with gold itself. Mm-hmm. Gold is an insurance asset. By the way, you don't need to own very much of it. Mm-hmm. In traditional gold bull markets, gold does so well that having 10% of your portfolio in precious metals related assets offsets the losses that you occur in other parts of your portfolio when the economy turns over. So it's important to know that you don't have to own too much, but you start with physical gold. Then, and this is tough for young people, you go to the highest quality miners. You don't try to outperform a market that's going to give you big returns anyway. Most of your portfolio has to go to the best companies. If you're expecting 600 or 700% market beta, you don't have to take too many risks to chase alpha because the beta is good enough. So now I'll answer your question, having given you that pontification. The most important metric for me is the net present value. And I define net present value as the present value of future cash flows from developed reserves and developable resources at current commodity prices or those commodity prices that are reflected in the forward commodity strip. In other words, when I value a gold company, I'm not assuming $2,000 gold or $3,000 gold or $5,000 gold. I'm assuming $1,750 gold. And I do a net present value calculation. Admittedly, I use a 5% discount rate, which is substantially greater than the avoided cost of capital. Traditionally, one would have used the US 10-year Treasury as the discount rate, the so-called risk-free rate of return. I'm not willing to use a 1.5% discount rate. I use a 5% discount rate. But at any rate, you arrive at that number, which is necessarily a rough number, but this isn't brain surgery. And you compare the net present value with the enterprise value of the company in question, which is to say market capitalization plus net debt minus cash. And companies that are cheaper than other companies by that metric go to the top of my list. The next thing I do is I look at that cash flow qualitatively. I have a huge fondness for tier one deposits. So I would like as much of that cash flow as possible to come out of deposits that are very large and very rich. Specifically to me, a tier one deposit has $10 billion in situ reserves and resources, recoverable, and is in the lowest cost quartile worldwide and the best return on capital employed quartile worldwide. In other words, I don't just want cash flow, I want quality cash flow. Once I've gotten through those two criterion, what I've done is I've taken 1,500 companies worldwide, and I've reduced them to a list of 6 or 7 that I think create the best list. Then where I'm able to, I qualitatively differentiate one more time by recycle ratio. I look for companies with intact management teams that have managed to replace grams produced, gold produced, with acquisitions, construction, and exploration efficiently. In other words, I look for replacement efficiency. And those criteria, value, quality of value, and the expectation of capital allocation efficiency are the metrics that I use to the exclusion of almost all others. I'm not looking in that part of my portfolio for leverage to the gold price. I'll get plenty of leverage all by itself. I don't need to maximize leverage. I don't need to maximize alpha when I'm expecting 600% beta. I would rather underperform a bull market very, very, very safely than outperform it, taking extraordinary risk.
Okay, because as you are no longer an employee of Sprott, you have commercial freedom of speech, which I particularly really like and appreciate on your interviews now. Now, moving forward, I would like to ask for specific companies to discuss them, but you said something interesting first, that you don't want to try to get alpha because the beta is going to be really good with the 500 and 600%. But does the Rick Rule in his 30s did that? Or he was investing in the Paladin Energies of the world, the Lumina Coppers?
Certainly all of the money that I now invest sensibly, I made by speculating. I wouldn't say nonsensically. I was an intelligent speculator. Yeah, and I'm not saying that you shouldn't try to outperform the market with part of your portfolio. Don't speculate with money that you can't afford to lose a lot of. Mm-hmm. And understand that as important as your capital allocation will be, your time allocation will become more important. Speculation is very hard work. And I succeeded as a speculator because I worked much harder than my competition. And I was much more disciplined. When I was in my 20s in particular, the competition had an investment thesis that went, got a hunch, bet a bunch. In other words, they were narratively oriented while I was arithmetically and technically oriented, which means that I outperformed them. And I am not suggesting that younger people who have some capital that they can afford to take risk with and some time that they are willing to employ shouldn't use part of their portfolio to outperform the market. Speculation has been wonderful for me. You point out Paladin, which went from 10 cents to $10, Lumina Copper, which went from $2 to $160. Certainly, if you can take the risk and have the time to allocate, be a speculator, but make sure that you capture some market data too while you're speculating.
Okay, because today is a special day in Spain. I don't know if you know it. The 22nd of December is the National Christmas Lottery Day. It's like Mega Millions or Powerball in the US, and probably no one listening has get the ticket of the $1 million because the probability is really low. So, and you said Paladin, Lumina Copper with those astonishing results. This is a specific question. Where does Rick Rule see these kind of opportunities now in the market for a big hit?
In order to participate in those, Lumina Copper came about because by the time Lumina Copper was founded, I had backed the founder already for 15 years. Opportunities like Lumina Copper are seldom available to people who are not well-known participants in the market who bring value to the process. Ross Beatty brought the concept to me and I funded it. He put up the intelligence and the work and I put up the money. The consequence of that was that was an opportunity that was available to me because of who I am, not because of anything else. Paladin was very different. Paladin involved a willingness to go into a market, uranium, that hadn't performed for 20 years and was in fact hated. It was pure luck on my part. I was attending a fairly obscure mining conference, and there was a guy, John Borshoff, an absolute genius and a slave worker who was trying to build a uranium company in an atmosphere where people hated uranium. It's important for your listeners to understand that the beginning market capitalization of Paladin was, if my memory serves me well, 1.5 million Australian dollars, or something under $1 million US. So in order to achieve the type of returns that I achieved on Paladin, you need to, first of all, be engaged in an activity that nobody else wants to compete with you in. which means it starts cheap. You have to back a genius who will chew through concrete to win. Those are very, very, very rare. And you have to be willing to endure incredible volatility. I talk with a smile about the increase in the Paladin share price from 10 cents to $10. Your listeners need to understand that before it went from 10 cents to $10, it went from 10 cents to 1 cent. And a ride where you've lost 90% of your principal is one that taxes you, at least emotionally. But the rewards were evident too. I don't see any commodity in the market now that is as hated as uranium was then, with the possible exception of coal. I don't see the opportunity in the coal space to find myself a John Borshoff or a market capitalization less than $2 million. I don't also see the circumstance where the coal price itself could match the uranium trajectory. Remember that the uranium price went from $8 a pound to $140 a pound. In order for that to happen, the coal price would have to go from $100 a ton to some number around the price of, anyway, it's unfeasible. What I do see is a situation where speculators should look through their portfolios at commodities that are out of favor. To me, the best speculative opportunity is probably in the silver equities, because the speculators are jilted lovers. They thought that the silver price would run in January and February and March of this year. It didn't. And so people are selling their silver equities wholesale and hate silver. I love asset classes that people hate, and people hate silver equities. I think the silver price goes higher. Maybe it takes 2 years. And I know from past experience that the combined market cap of the legitimate silver companies is so small that when the general investors come into it, the market cap won't be able to hold the money, which is to say that the prices will likely explode higher. I think for investors, not speculators, particularly if global travel declines again as a consequence of the new COVID variant, that oil and gas stocks for investors rather than speculators verge on being free. The market capitalizations of the oil companies are assuming, from the work I've done, $45 oil in a world where the consumer is paying 70. If the oil price falls as a consequence of declining air travel with the COVID variants, and the price of silver equities falls more, I think you'll see a once in a decade opportunity for investors rather than speculators in the oil space.
Okay.
Very nice. So Rick, finishing already, do you want some recommendation, because you've been in this particular sector, well, commodities related investing during almost all your career? So someone that is, for example, because right now, for example, in Spain, some people are starting to invest, and some people are watching, for example, this channel. They want to start invest and get some alpha, because inflation is going to destroy all of our money. But do you recommend something for that people, like, don't do this, this is the best mistake you can make, so don't do it, or do this, learn about that? Because there's also, I think, everyone is like very focused on the same, like Facebook, Google, Apple, all the big techs right now, and no one is like seeking value out of that. So what do you recommend? Do you recommend like focus on some industry, just go general? What will be your best tip for young people?
I think young people in Spain who have a technological bent, which is to say young people who have studied engineering as an example and understand technology, should look to technology. Part of being an investor isn't so much the investment as the investor. If you have the ability to outcompete other people and you have discipline, you will do well. I don't invest much in technology. I used to, in 1990 or so, when the technology stocks seemed cheap. I don't invest much in technology because I don't understand much about technology. You are speculating on the future of subjects that I can't either spell or pronounce. And so I don't do that. I don't have the ability to analyze those businesses because they're too complex for me to analyze. For younger people, I think the first investment that you make is in yourself, in your education and in your attitudes. Understand that if you are in a sector where you're going to get a lot of upside, you're going to get some downside first. And you have to have both the fiscal and the psychological durability to stay the trade. Younger people too need to understand the eighth wonder of the world, which is compounding. It's odd that when I was a youngster and I had a lot of time left on earth, I was extremely impatient. Now that I'm 68 years of age, ironically, now that I have less time on earth, I've learned by experience to have 5 or 6 year duration, or hopefully 10-year duration on my investments. You make tenfold returns when time is on your side. A tenfold return is a series of 30 or 40 or 50% annualized returns. And so if you are looking to make money as a speculator, understand two things. When I look at the anatomy of the 1,000% returns I've gotten in my life, and mercifully, I've gotten many of them, two things have been required. Well, three really. I have to be in out of favor sectors. They have to be cheap at the beginning. It takes me 5 or 6 years. And I normally experience at least one, but sometimes two, 50% price declines during the period of time where I've enjoyed the 1,000% gain. Too many people want to be a contrarian when it's popular, which is to say they want a contrarian narrative that's already proven itself with price appreciation. A contrarian narrative and a contrarian action are two very different things. The second thing is that the investor needs to be patient. Time has to be on his or her side. They have to be prepared to own the asset for 5 or 6 years to get that 1,000% gain. And then, of course, they need to be prepared for volatility. The fourth is you need to acknowledge when you're wrong. If you buy a stock for a certain reason and the reason doesn't come true and you're down 30%, you need to sell that stock. Too many people who buy a stock in American parlance at $1 and see it decline to 70 cents, where the speculative reason to own the stock goes away, are leery about selling something that they paid $1 for 70 cents. And the consequence of that is that they hold it and end up selling it for 10 cents. When the reason to own an investment goes away, the investment has to go away too. The reason isn't price. The reason is something fundamental to the company. If it's an exploration company, if the exploration thesis was disproven by a couple of drill holes, that means the exploration thesis isn't valid anymore, which means you have to sell the stock, irrespective of the price. The last thing I would say, and this is going to seem contradictory to what I said earlier, is that you have to remain partly liquid. Despite the fact that having cash, and I regard gold and silver as good cash, albeit volatile cash, you have to have liquidity, even if the liquidity is costing you purchasing power. Because if we come into a circumstance where we have a liquidity squeeze like 2008, having liquidity will give you the tools and hopefully the courage to take advantage of that situation as opposed to being taken advantage of by that situation. So despite the fact that cash costs you purchasing power every year, I advocate that people have at least 10% of their portfolio in very liquid assets. For me, I include gold and silver as liquid assets because I am very willing to sell them to buy something that I see as more attractive. Many people wouldn't sell their gold if it was down in price, even if there was something that was more attractive on the horizon, because they wouldn't want to face the loss that they had incurred in the gold. I'm way, way, way past that now. So for me, gold and silver, in addition to being insurance, are liquidity. And if there was a circumstance where in my country, the S&P 500 sold off by 60 or 65%, I would happily liquidate some of my precious metals holdings to buy a package of the largest and finest industrial corporations in the world, if that circumstance presented itself. So study, be contrarian, be cheap, be tolerant of volatility, understand compounding, be patient, and be willing to admit defeat, be willing to accept losses. It's a tall order, and it's taken me 50 years to get it right most of the time.
Thank you, Rick.
Pleasure.
So, well, we are already finishing. I don't know if Luis want to ask the last question or.
Well, I was going to introduce to the rankings, but I don't know. You said the.
I absolutely would like to do the rankings offer if it's appropriate.
Yes,
Sure,
of course.
Sure.
I mean, it's really good. We have tried, Javier and me, and really like it.
It's very worth it.
If your audience cares what I think about their specific natural resource portfolios, rather than the topic natural resource investing, I'm prepared to help. They can go to a website, ruleinvestmentmedia.com, enter their natural resource stocks. Please no pot stocks, please no crypto, please no technology. I'll rank those personally, 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think my comments might have value. Further, in a general sense, if your listeners mention the word charts in the questions and comments, I'll send the Barron's Gold Mining Index chart, and I'll send a 100-year commodity chart, which talks about just how cheap the stuff of mankind is relative to other asset classes in financial markets, going back 100 years. Once more, that's ruleinvestmentmedia.com.
Thank you, Rick. So, bueno, lo digo en español. Cualquiera que quiera que vaya a ruleinvestmentmedia.com y rellene las empresas y se las mandará Rick de vuelta con el ranking. So, thank you, Rick. It was a pleasure for us to have you in the channel. So we really appreciate your time, and thank you for coming.
A pleasure and an honor for me. When COVID settles down and my wife and I come to Spain, hopefully we can all meet in person, which would be very pleasant.
Just call us. We will give you a tour to Madrid.
I look forward to that.
I fear that you like beer, so that will be a good plan.
I like tempranillo. I like all spirituous beverage.
Okay.
Thank
you
you
for your time.